Something major happened in the silver market today. Not because supply changed, not because demand suddenly shifted, and not because anything fundamental about silver's underlying value was altered. It happened because of a rule change, a margin requirement adjustment that went into effect this morning. If you followed silver today, you probably noticed it right away. Silver reached $84 an ounce last week, a level we haven't seen in roughly 45 years on an inflation-adjusted basis. Then today it sold off hard, down more than 5% at one point. For some investors, a meaningful chunk of recent gains vanished within hours. And here's the key thing to understand. This move wasn't because silver suddenly became worth less. It wasn't a demand collapse. It wasn't a surprise surge of new supply hitting the market. Instead, a large part of this was driven by a policy change. Advisory number 25-393 from the CME Group, the organization that oversees the exchange where silver futures are traded. Here's exactly what happened. On December 26th, just 3 days ago, the CME Group announced that effective today, Monday, December 29th, they would raise the initial margin requirement for March 2026 silver contracts to $25,000 up from $20,000 just 2 weeks earlier on December 12th. That's a 25% jump in the cash. Traders must post simply to keep their positions open. If you're new to futures, here's what that means in plain English. Imagine you bought a house with a 20% down payment. Everything is fine, you're living there making your payments, no issues. Then one morning the bank calls and says the down payment requirement is now 50% and you need to come up with the difference quickly or they'll sell the house. That's essentially what happened to many silver traders today. They received margin calls they couldn't meet on short notice. And when you can't meet a margin call, you don't get to exit politely. Your broker liquidates the position immediately at whatever price the market offers. And here's the dynamic that matters. When a lot of traders are forced to sell at the same time, what happens to price? It drops often fast. In the first 4 trading days of December alone, reports indicate that more than 47 million ounces of silver in paper contracts were liquidated. That's an enormous amount of selling pressure compressed into a short window. So here's a question worth asking. Who typically benefits from a sudden sharp drop? Think about it. If you had positioned for silver to fall and you were taking heavy losses as silver pushed up toward $84, what would improve your situation? A wave of forced selling that drives prices lower. The commitment of traders report publicly available data shows that commercial traders, including large banks and institutions, have maintained significant short positions in silver. As silver rose, those positions were showing major losses on paper. And then for the second time in 2 weeks, the CME raised margin requirements again. This kind of sequence has happened before. Similar margin increases occurred during the silver rally in 2011 and also during the 1980 Hunt Brothers episode. Now, I want to be completely clear. I'm not saying this is definitely market manipulation. The CME's position is that margin hikes are a risk management tool during periods of high volatility. And that explanation does make sense from a risk standpoint. When prices move fast, it's reasonable to raise margin requirements to protect the exchange and its members from default risk. But here's what I think deserves a closer look. This pattern of margin hikes during rallies has shown up more than once across market history. Understanding that pattern can help investors make better informed decisions. And that's what this video is about. This is educational content focused on market mechanics. I'm going to walk through what happened, put it in historical context, review the public data we can access, and share my analysis. From there, you can draw your own conclusions. In 1980, the Hunt brothers were building large silver positions. Silver reached $50 an ounce. Then the CME introduced something known as Silver Rule 7, which placed restrictions on buying on margin. After that, silver fell sharply and the Hunt brothers ran into severe financial trouble. In 2011, silver climbed from around $8 to nearly $50 during the quantitative easing era. As it neared the peak, the CME raised margin requirements 5 times in 9 days. Silver dropped almost 30% in the weeks that followed. And now here we are in December 2025. Silver just broke above $80 for the first time in history. And the CME has increased margins twice in 2 weeks, with the latest change taking effect today. Is there a pattern? That's for you to judge. But I do think this history matters for anyone who follows precious metals. So let's look at what actually happened today, because the details are important if you want to understand these dynamics. Silver opened this morning around $78.44, according to market data already below the $84 high we saw last week. The market was digesting the margin increase news. As Asian markets closed and European markets opened, selling pressure intensified. By mid-morning, silver was trading around $75, down roughly 4%. Then came what traders often call a flush, a wave of selling that pushed silver below $74. At one point, silver traded more than 10% below the recent high. And here's what matters about this kind of price action. It looks more like forced liquidation than normal selling. You can often tell the difference by the shape of the move. Normal selling tends to come in waves, with buyers stepping in near support levels. Forced liquidation often looks like a more direct drop because the sellers aren't choosing their price, they're selling because they have to meet margin calls. The CME's margin increase meant that traders holding long silver positions suddenly needed 25% more cash in their accounts. If they didn't have it, they had a very short window to come up with the funds. And for many traders, especially retail traders and smaller funds, that's difficult over a holiday weekend when banks and wire transfers can move more slowly. So what happens? A lot of liquidation. Trading data indicates that in just 15 minutes during one of the biggest selling waves, more than 13,000 contracts changed hands. That's equivalent to 67 million ounces of paper silver sold in a quarter hour. To put that in perspective, it's roughly like 2 months of global silver mine production dumped into 15 minutes of trading. This is exactly the kind of thing some analysts point to as unusual in these markets, the paper market, where futures and derivatives trade can sometimes behave very differently from the physical market where real metal is actually bought and sold. Let me share an observation. While the paper price was sliding today, I checked prices at major online bullion dealers, JM Bullion, APMX, and SD Bullion. What I saw was interesting. The price for physical silver eagle coins was essentially unchanged. In some cases, the premium overspot, the extra you pay above the paper price, actually moved higher. Think about that for a moment. The paper price dropped more than 5%, but the price of physical silver you can actually hold didn't move much. In a few cases, premiums rose because dealers may expect that sharp dips bring in buyers looking for a perceived discount. That detail suggests something worth considering. The physical market may be sending a different signal than the paper market. If silver were truly worth 5% less today than it was on Friday, you might expect dealers to cut prices to move inventory. Instead, many held firm or even raised premiums. Now, this is only one data point, and there are multiple possible explanations, but it's still useful to note if you're trying to understand how these markets function. The silver market has been running a supply deficit for 5 consecutive years, according to the Silver Institute. In 2024, estimates suggest the world used roughly 1.3 billion ounces of silver, while production was only about 1 billion ounces. That's a gap of around 280 million ounces that had to be filled from existing stockpiles. So where does that metal come from? Exchange inventories and other sources. London Bullion Market Association warehouses have been drawing down. COMEX registered silver has seen notable outflows. Since October of this year, reports indicate that more than 53 million ounces have moved out of the registered category. Additional amounts have left COMEX depositories entirely. In other words, silver appears to be shifting away from the exchange system into private hands, into industrial users, into vaults in Asia, and into the possession of people who prefer holding physical metal rather than paper claims. And yet today, the paper price fell sharply because traders were forced to sell futures contracts they could no longer afford to hold. That apparent disconnect is what makes precious metals markets so interesting to study. In the short run, pricing can be heavily shaped by paper trading mechanics. Over longer periods, physical supply and demand fundamentals tend to reassert themselves. Solar panels still need silver, electric vehicles still need silver, AI data centers still require silver in their electronics. On the demand side, growth continues because these technologies keep expanding. On the supply side, the constraints remain. Roughly 75 to 80% of silver production comes as a byproduct of mining other metals such as copper, zinc, and lead. That structural reality limits how quickly silver output can rise even when prices climb. Now let's look at who's positioned on each side of this market, because market structure often helps explain price behavior. Every move creates winners and losers, and positioning provides useful context. The Commitment of Traders report is published weekly by the Commodity Futures Trading Commission. It shows which groups hold what positions in the futures market. This is public data that anyone can access. And in recent reports, commercial traders, primarily large banks and bullion dealers, have held sizable short positions in silver. That's not unusual. Commercial traders often use shorts as hedges against physical inventory or other business exposures. It's a normal feature of commodity markets. When you're short, you benefit when prices fall. When you're short and prices rise, the position shows losses until you close it. As silver pushed toward $84, those commercial short positions were showing meaningful paper losses across the sector. Now, here's where I want to add my analysis clearly labeled as my perspective based on publicly available information. The CME raised margin requirements for the first time on December 12th, increasing margins from around $20,000 to $22,000 per contract. Silver kept moving higher after that first increase. The margin hike didn't immediately cool the rally. Then just 2 weeks later, another increase, this time to $25,000. That's a total increase of about 25% from where margins started earlier in the month. And the change took effect today, right at the start of the final trading week of the year, when many institutions are doing year-end rebalancing and trading volumes are often lower. Lower volume means the same amount of selling can move prices more. Forced liquidation during thin conditions can produce outsized swings compared with normal periods. And here's what I find notable about the historical pattern. Again, this is my interpretation of past events. Major silver rallies have often been followed by margin requirement increases. In 1980, Silver Rule 7 didn't just raise margins, it placed significant restrictions on margin buying altogether. If you wanted to buy silver futures, you had to put up far more cash. The result was reduced buying power across the market. In 2011, 5 margin increases in 9 days sent a similar signal. Each increase forced some traders out. Each liquidation wave pushed prices lower, which increased margin pressure, which forced more selling. That cascading effect is a well-known market dynamic. And now in 2025, we're seeing margin increases during another rally. The CME says this is standard risk management, and that's a legitimate role of an exchange. Exchanges are supposed to manage counterparty risk. Meanwhile, the Shanghai Futures Exchange has shown silver trading at a premium to COMEX prices. In well-functioning markets with effective arbitrage, those prices usually stay close. When they diverge meaningfully, it can suggest that moving physical metal between markets is difficult or that supply is tight in a particular location. China's only silver fund, the UBS SDIC Silver Futures Fund, recently had to pause new retail inflows because prices surged well above the net asset value of its holdings. That points to strong demand for silver exposure in that market. And these kinds of data points are useful to keep in mind when you're trying to understand the bigger picture. Now let me address the standard explanation directly. The CME's official position is that margin increases are risk management measures. When volatility rises, margin requirements should rise as well so traders can meet their obligations. That helps protect the exchange system from defaults that could have broader consequences. That explanation is reasonable and consistent with how exchanges are designed to function. I'm not disputing that risk management is a legitimate goal. What I'm emphasizing is the pattern and timing of these adjustments, and the idea that understanding this pattern can help investors prepare for similar situations in the future. If you're holding leveraged positions in silver or other volatile commodities, you should recognize that margin requirements can rise sharply during rallies. And when that happens, it can trigger forced liquidation regardless of how you feel about the fundamentals. That's information that can help you make smarter decisions about position sizing and leverage. Whether you interpret this pattern as concerning or simply as normal exchange operations is up to you. The key point is that paper market mechanics can drive short-term price moves that don't always match what fundamentals might imply. Understanding those mechanics is valuable for anyone participating in these markets. Now, let's step back from the paper market and look at what's happening in the physical silver market. Silver is ultimately a real metal with real industrial uses, and physical supply and demand fundamentals matter. I mentioned the solar industry earlier, but the details are worth exploring because it's a major driver of demand. According to the Silver Institute, photovoltaic applications used around 230 million ounces of silver in 2024, and projections suggest that could rise above 300 million ounces per year by 2030. Each solar panel contains about 20 grams of silver in conductive paste that creates electrical pathways on silicon wafers. Research from multiple institutions suggests solar production is becoming a steadily more important source of silver demand. Efforts to substitute other metals, such as copper or aluminum, have had limited success so far. Silver's electrical conductivity delivers performance advantages that are difficult to match with cheaper alternatives in the specific applications used in solar cells. China dominates solar manufacturing, accounting for the majority of solar-related silver consumption. And the same country that leads solar manufacturing also controls a significant share of global silver refining capacity. That concentration of manufacturing and processing in one place is worth noting. Then there's the electric vehicle market. Traditional internal combustion engine vehicles use roughly 15 to 28 grams of silver. Hybrids tend to use more, and battery electric vehicles often use around 25 to 50 grams, roughly double the silver content of conventional vehicles. Silver is used in EVs for battery management systems, power electronics, charging infrastructure, and electrical contacts. Industry forecasts suggest automotive silver demand will keep rising as EV adoption expands. And there's another demand driver gaining momentum: artificial intelligence infrastructure. AI workloads require massive computing capacity, which means more data centers and more hardware. Silver's electrical and thermal conductivity make it useful across many of these components. Global IT power capacity has increased dramatically over the past 2 decades. Every server, every chip, every connector uses some amount of silver. As AI deployment accelerates, this demand channel is likely to grow further. Now, let's shift to the supply side. Global mine production has been relatively steady, roughly 800 to 850 million ounces per year. In 2024, production reached about 844 million ounces, close to a 7-year high, but still meaningfully below total demand. Here's a structural point that matters. About 75 to 80% of silver comes as a byproduct of mining: copper, zinc, lead, and gold. Only around 25% comes from primary silver mines. That means silver supply can't respond quickly to price signals. If silver prices double, it doesn't automatically produce a matching surge in output. Primary silver mines can ramp up, but they represent a minority of supply. Most production is tied to base metal economics, which limits how fast total silver output can expand. A major development is China's new export licensing requirement starting on January 1st, just 3 days from now. The new framework requires exporters to meet minimum annual production thresholds and satisfy additional criteria. In effect, it narrows which companies can export silver. Various sources indicate that China controls a significant share of global silver refining capacity. If these export restrictions reduce availability outside China, they could influence global supply dynamics. Why might China take this step? One plausible reason is domestic priority. China's solar industry, EV manufacturing, and electronics production all require large silver inputs. Retaining more supply at home could support those industries. Meanwhile, inventories at major exchanges have been declining. COMEX registered silver, the portion available for futures delivery, has fallen substantially from earlier peaks. London Bullion Market Association inventories have also been drawn down. The metal appears to be moving out of exchange vaults and into industrial supply chains and private holdings. Recycling contributes some supply around 150 million ounces per year, according to industry estimates, but it doesn't fully close the gap. Put together, these factors point to structural supply constraints that are unlikely to disappear quickly. The Silver Institute projects ongoing deficits, and yet today, because of a margin increase on paper contracts, the spot price still dropped sharply. That tension is what makes silver such a compelling market to analyze. Short-term price action can be driven by paper market mechanics. Over longer horizons, price trends tend to reflect physical supply and demand realities. Sometimes those forces point in different directions. Understanding both the paper mechanics and the physical fundamentals gives a clearer view of what's happening. I've referenced 1980 and 2011 several times for a reason. Those episodes deserve a closer look because they highlight patterns that may help frame current events. Let's start with the Hunt brothers story. Nelson William and Lamar Hunt were the sons of Texas oil billionaire H. L. Hunt. After their father died in 1974, they inherited substantial wealth and chose to put a major portion of it into silver. The logic had a clear foundation. The United States had recently moved away from the gold standard in 1971. Inflation was running hot. The dollar was weakening. Precious metals looked like a reasonable hedge against those conditions, so they began accumulating silver. Over the following years, the Hunt brothers and their associates amassed an estimated 200 million ounces of silver, representing roughly one-third of the world's tradable supply outside government stockpiles. They took physical delivery, removing metal from available market supply. As supply tightened, prices surged. Silver climbed from about $6 an ounce in early 1979 to $48.70 in January 1980, roughly a 700% gain in about a year. Then, regulatory intervention arrived. COMEX introduced Silver Rule 7 on January 7, 1980. The rule placed significant restrictions on buying silver futures on margin. It sharply increased the cash required to open new positions. At the same time, Federal Reserve Chairman Paul Volcker was aggressively raising interest rates from around 12% to 20%. That made borrowing to finance commodity positions extremely expensive, and the Hunt brothers had borrowed heavily to fund their purchases. Under the new rules, they faced margin requirements they couldn't meet. On March 27, 1980, often referred to as Silver Thursday, they missed a major margin call. Silver fell hard, dropping from around $21 to about $11 in a single day. The Hunt brothers lost more than $1 billion. They later faced bankruptcy, and in 1988 they were found to have attempted to manipulate the market and were ordered to pay significant damages. Fast forward to 2011. The financial crisis had shaken global markets. The Federal Reserve responded with quantitative easing, creating trillions of dollars in liquidity. Interest rates were near zero. Silver, like gold, drew investors worried about monetary policy and currency debasement. The price rose from around $8.50 in late 2008 to nearly $50 in April 2011, another major rally. And then the CME raised margin requirements. Over a span of 9 days, margins were increased 5 separate times. The cumulative effect roughly doubled the margin required to hold silver futures positions. The result looked similar to 1980 forced liquidation, cascading margin calls, and a sharp decline. Silver fell nearly 30% in the weeks that followed, and the rally ended. What's notable about 2011 is that there wasn't a single entity trying to corner the market the way the Hunt brothers had. There were many participants who wanted silver exposure due to monetary concerns, and they got caught in the same margin squeeze anyway. And now here we are in 2025. Silver has been in a bull market supported by industrial demand growth and supply constraints. The move from $31 at the start of the year to $84 this month has been substantial. Yet, the CME has implemented margin increases twice in 2 weeks, echoing the historical pattern. The difference this time, and this is important context, is that the physical supply situation appears tighter than in previous cycles. In 1980 and 2011, there was a lot more physical silver available. The squeezes were largely concentrated in paper contracts. Today, exchange inventories are lower. Industrial demand is still expanding. Major producers, including China, are putting export restrictions in place. None of those physical realities guarantee that prices rebound quickly after paper market pressure, but they do suggest the underlying backdrop hasn't suddenly changed. Markets can stay volatile for long stretches, but today's move doesn't necessarily mean the demand drivers disappeared overnight. The historical record shows that margin increases can hit leverage positions hard and trigger sharp, sudden drops. Understanding that pattern can help investors manage risk more effectively. At the same time, the supply and demand picture in 2025 has features that look different from earlier cycles. How these forces ultimately play out is something we'll observe over time. I'm not forecasting a specific outcome here. I'm laying out historical context and current data so you can form your own informed view of what's happening. So where does this leave someone who already owns silver or is thinking about it? If you're watching this, you probably have some exposure or you're evaluating an entry, and you may have watched positions pull back today. What should you think about? First, a clear note: I'm not a licensed financial advisor. This is educational content based on publicly available information and my analysis. Your situation is unique, and you should speak with qualified professionals before making investment decisions. With that said, here are a few factors worth considering. If you own paper silver ETFs, futures, or mining stocks, you're exposed to the type of margin-driven dynamics we saw today. The paper market can move based on leverage, changes, liquidity conditions, and institutional positioning. Your long-term thesis about silver could be right, and you can still experience significant short-term volatility because of paper market mechanics. That doesn't mean paper exposure is automatically bad. Paper products offer liquidity and convenience that physical metal can't match. But holding paper also means accepting paper market risks. Today's price action is a real-world example of what those risks can look like. Physical silver behaves differently in some important ways. If you own coins, bars, or other forms of metal, today's price drop may have reduced the theoretical value of your holdings, but it didn't change what you actually own. You still have the same ounces. The metal didn't vanish. And as mentioned earlier, physical premiums at dealers didn't necessarily fall in lockstep with the paper price. Physical demand often increases on sharp dips because some buyers treat pullbacks as opportunities. The trade-offs with physical are storage, security, and liquidity. You can't sell it with a click at 3 a.m. You need to find a buyer. But you also can't be forced out of a physical position by a margin call. Here's my perspective on the current situation framed as analysis, not advice. The CME's margin increases are intended to manage exchange risk. That's their stated purpose, and it's a legitimate function. Whether there are additional side effects is a matter of interpretation. What margin changes cannot do is rewrite the underlying supply and demand fundamentals. Solar panels still need silver. Electric vehicles still need silver. AI infrastructure still depends on silver. China is still moving forward with export restrictions. The broader supply-demand picture didn't suddenly change because of today's trading. In previous cycles, margin hikes were followed by extended periods of weakness in silver. In 1980, it took years to work back toward prior highs. After 2011, silver didn't return to those levels again until much later. But those earlier cycles were more heavily fueled by speculation. The 2025 rally has stronger support from industrial demand growth and documented supply constraints. That doesn't guarantee any particular outcome, but it does add context for evaluating what's happening. If you're considering buying, it's important to understand exactly what you're buying. Paper silver will remain subject to paper market dynamics. Physical silver has a different profile, including higher transaction costs and storage requirements. And if you're thinking about selling, it's worth asking why. Did the fundamentals shift, or did market mechanics create temporary pressure? In my view, the fundamentals look largely unchanged from last week. In fact, the supply situation may be getting tighter with China's export restrictions set to take effect soon. Key technical levels I'm watching include the $70 area. That's a psychologically important round number, and it's roughly where silver traded before the recent acceleration higher. How price behaves around that zone could offer clues about whether the broader trend remains intact. But here's the most important point. Don't let short-term price action, especially when it's driven by identifiable mechanical factors, rewrite your long-term perspective if that perspective is based on fundamentals. The people who exited silver around $10 in 1980 missed the eventual recovery. Those who sold at lower levels in 2011 and 2012 didn't participate in the more recent move to $84. Forced selling often looks badly timed in hindsight. That's not a recommendation to hold through every situation. Position sizing matters. Risk management matters. Your personal financial circumstances and goals matter. It's simply an observation that decisions driven purely by short-term volatility without broader context can lead to outcomes people later regret. Whatever you choose, make sure it's based on your own analysis and aligned with your goals and situation. Don't let emotion push you into decisions in either direction. Now let me share what I'm watching in the days and weeks ahead, factors that could influence where silver goes from here. First, China's export licensing requirements take effect on January 1st, just 3 days from now. We should begin to see signs fairly quickly of how these rules affect real metal flows. If Chinese silver exports drop meaningfully, that would tighten global supply. Second, the silver market is moving into the January delivery month with notably high open interest for what is usually a smaller delivery period. That means a large number of futures contracts are coming due, and holders have to choose whether to roll them forward into later months or stand for physical delivery. If delivery demand stays strong, that can add pressure to exchange inventories. Third, year-end positioning should be mostly finished by the end of this week. Institutional investors that needed to adjust positions for annual reporting will largely have done so, which removes one potential source of selling pressure that may have contributed to recent volatility. Fourth, Federal Reserve policy still matters for commodities broadly. If inflation stays elevated and the Fed keeps rates higher for longer, that can be a headwind for metals in general. If the Fed shifts toward easing, as some market pricing implies, that has historically been supportive for precious metals. Fifth, the gold to silver ratio is worth watching. This ratio reflects how many ounces of silver equal the value of 1 ounce of gold. It recently fell from above 100 to around 59. When the ratio declines, silver is strengthening relative to gold. Historically, lower ratios have sometimes been followed by periods of silver outperformance. Now let's talk about the possibility of additional margin changes. Could there be more? Yes. The CME can adjust margin requirements whenever it determines that it's necessary for risk management. If volatility persists or increases, additional hikes are possible. And if that happens, we could see more forced liquidation and added downside pressure. That's a risk that comes with holding leveraged paper positions in any volatile commodity. But there are limits to how far margin changes can push prices when physical supply is genuinely constrained. Eventually, if paper prices drift too far from physical realities, arbitrage tends to pull them back toward alignment. Buyers can step in, purchase futures at depressed prices, and then take delivery, drawing down exchange inventories and creating its own form of pressure. We're already seeing signs of that dynamic. COMEX registered silver has been declining. London inventories are low. Arbitrage activity between paper and physical markets remains active, and China's role is a key variable. If Chinese buyers are willing to pay premiums for physical silver to meet industrial needs, they have substantial financial capacity to compete for available supply. They've built strategic reserves in other commodities, and it's possible they could pursue a similar approach with silver. That leads to my overall perspective on the current setup. The silver market is at a point where short-term paper dynamics and longer-term physical fundamentals may be sending different signals. On one side, paper market mechanics, including margin changes, can generate significant short-term pressure as we saw today. That's a real risk for anyone using leverage. On the other side, physical fundamentals appear stronger than they've been in decades. Supply deficits persist. Industrial demand is rising. Major sources of supply are becoming more restricted. Which force dominates depends on your time horizon. In the near term, paper mechanics can drive outsized moves. Over longer periods, physical realities tend to reassert themselves. The real question for individual investors is whether they can get through short-term volatility and still potentially benefit from the longer-term fundamentals. That largely comes down to position sizing, leverage discipline, and understanding exactly what you own. If you were heavily leveraged in paper exposure, the past few days may have been difficult and you may have faced margin calls at the worst possible times. If you hold physical silver or paper positions sized conservatively, today's move was likely frustrating but still manageable. In that case, you have the ability to wait and see whether conditions improve. I'll keep monitoring the situation and sharing analysis as things evolve. Markets are always changing, and staying informed helps you make better decisions. This video is for educational purposes. I've shared publicly available information and my interpretation of it. You should do your own research and consult qualified professionals before making financial decisions. If you found this analysis helpful, please consider liking the video. It helps with visibility. Subscribe if you'd like to see future analysis on precious metals and financial markets, and share your thoughts in the comments. I'm interested in hearing different perspectives. We're in a fascinating period for precious metals, and understanding the dynamics at play can help you navigate whatever comes next. Thanks for watching. Before I close, let me summarize the key points and offer a final perspective. What happened today was a sharp drop in silver driven largely by a CME margin requirement increase that took effect this morning. This was the second margin increase in 2 weeks, and it forced many traders holding long positions to liquidate because they couldn't meet the higher capital requirements on short notice. This kind of forced liquidation creates selling pressure that's mechanical rather than fundamental. Traders weren't selling because they changed their view on silver's value, they were selling because they had to. And this pattern has historical precedent. In 1980, margin and rule changes contributed to silver collapsing from nearly $50 to around $10. The Hunt brothers, who had accumulated roughly 1/3 of the world's tradable silver, were among those forced to liquidate. In 2011, 5 margin increases in 9 days helped end a rally that had carried silver from about $8 to nearly $50. Silver dropped roughly 30% in the weeks that followed, and now in 2025 we're seeing margin increases during another major rally. The CME says this is standard risk management during volatile periods, and that's a legitimate exchange function. Whether you view the pattern as concerning or simply as normal market operations is a matter of interpretation. I've presented the information so you can make your own assessment. What's different this time compared with earlier cycles is the physical supply picture. Exchange inventories at COMEX and in London are relatively low. Industrial demand continues to grow, driven by solar EV and electronics applications. China is implementing export restrictions that could tighten supply further. And those physical realities didn't change today. A margin adjustment on paper contracts doesn't create or destroy physical silver. It changes trading dynamics, not fundamentals. That's the core insight I hope you take from this video. There's a meaningful distinction between paper market mechanics and physical market realities. In the near term, paper market mechanics can drive price action. Over longer stretches, physical fundamentals tend to reassert themselves. For investors, that means there's value in understanding both sides of the market. If you trade with leverage, you have to recognize that margin requirements can change and plan for that possibility. If you invest based on fundamentals, you need the patience and the position sizing to tolerate short-term volatility. Neither approach is automatically right or wrong. They're simply different strategies with different risk profiles. What matters is knowing which approach you're taking and managing your exposure accordingly. Let me share a few general principles that apply regardless of your situation. Position sizing matters enormously. Positions that are too large relative to your overall portfolio can pressure you into decisions during volatility that you later regret. More conservative sizing gives you staying power. Leverage is a double-edged tool. It can magnify gains, but it can also magnify losses and create margin call scenarios. Using leverage also means accepting that someone else can force you out of a position at a time you wouldn't choose. Emotional reactions to short-term moves often lead to poor outcomes, whether it's panic selling near a low or chasing a rally near a high. Having a plan and sticking with it tends to produce better results over time. It also matters to understand what you actually own. Paper silver and physical silver behave differently. ETFs and futures involve counterparty considerations. Mining stocks carry company-specific risks. Know your exposures and what risks come with each form. Silver is a fascinating market because it sits at the crossroads of precious metals, investing, and industrial commodities. It has monetary characteristics that have attracted people for thousands of years, and it also has industrial applications that keep expanding as technology advances. Today's events don't change the long-term story. They're part of the ongoing push and pull between paper markets and physical realities that defines modern commodity trading. If you're interested in silver and precious metals, I encourage you to keep learning how these markets operate. The more you understand, the better positioned you'll be to make decisions that support your goals. Thank you for watching. I've aimed to provide factual information, historical context, and analytical perspective, while separating what's established fact from what's interpretation. The views expressed here are my own based on publicly available information. This is educational content, not financial advice. Please consult qualified professionals before making investment decisions. If you found this valuable, a like and subscription would be appreciated, and I always enjoy reading comments and different perspectives. Whatever happens next in the silver market, stay informed, stay rational, and make decisions that fit your own goals and circumstances. Take care.